Good afternoon, everybody. How to not wreck your portfolio, aka risk management. Risk management usually ranks pretty low on the priority list of most traders, typically way behind finding a better indicator, better entry signals, worried about stop hunting or coming up with excuses, algo trading practices, and so on. But risk management is definitely essential to successful trading. Money and risk management is a very unsexy area in the trading world. And it's typically after months of losing money and endless frustrations that typically traders start to focus on this aspect of trading. However, today I'm going to take you through the way I manage risk and a few easy tips that you can implement in order to protect your portfolio and quit getting wrecked. So every battle is won before it's fought. Battles don't win wars, planning and strategy do. This is a quote by Sun Tzu, and it very much applies to trading. You have to have a plan going into trading. You could be a great analyst, but an unprofitable trader if you don't use proper risk management. Conversely, you can also be a bad analyst, but a profitable trader with proper risk management. Trading crypto is stressful and an exhausting process sometimes, especially with the volatility we have. Risk management is a must. Stop losses are much. Planning out everything with your trade is an absolute must if you want to have longevity in the market. Volatility hits when we least expect it. Stop outs are extremely common daily basis, even more so than traditional markets. But no matter what, when a trade goes bad, you just need to stick to your plan and your strategy. So plan the trade and trade the plan and never deviate from that. So trader A versus trader B. We can see trader A has a 50% win rate and a 50% loss rate, so 50-50. But, however, he still has a $200 average profit and $100 average loss. Trader B has a much higher win rate as 75% with a 25% loss rate. However, his average loss is $400 compared to his average profit of $100. So what's the difference on all this? Well, it's all in the trade structure and risk management that they use. Unsuccessful traders often enter a trade without having any idea of the points at which they will sell at a profit or a loss. Like gamblers on a lucky or unlucky streak, emotions begin to take over and dictate their trades. Without proper knowledge about risk management and a plan, profitable trading is practically impossible, especially if you want to go long term. Yeah, a lot of traders may have a bit of luck short term, but typically you're not going to make it long unless you have a risk management plan and you go into every single trade and stick to that. A trader needs to understand how to manage his or her own risk, size his or her own positions, create a positive outlook for his or her performance, and set his or her orders correctly if they want to become profitable and a professional trader. Risk management is kind of like the foundation of a house. When you build a house, you first start with the foundation layers, and only then you start to build the walls and the roof and everything else. You've never seen a house built from the roof down. It's always starting at the foundation. Risk management is the foundation of a successful trading plan. So the process I use to enter into a trade goes like this. Once I've identified an entry, then I go to look to identify my stop loss. From there, then I identify my take profit. And then between those 3 points, I then measure the risk and reward and see if it meets the requirements that I need to enter into a trade. I typically look for at least a 2-to-1 risk-reward ratio. Obviously, the higher you get, the more favorable the trade is. But if it doesn't match your requirements, you skip the trade. You don't try to widen your take-profit order or tighten your stop loss to achieve a higher reward-risk ratio. So let's say I've identified my entry. Next thing I look at is where my stop should be. There's typically 3 places I look for a stop loss: moving averages, support or resistance, or prior price action lows or highs. One tip is many trading strategies tell you to use a fixed amount on your stop loss and take profit orders. Those shortcuts and generalizations completely neglect how price moves naturally and how markets work. Trading with fixed distances really doesn't allow you to choose a reasonable price level, and it takes away all the flexibility you need to have as a trader. I don't believe a fixed stop loss takes into account the natural movements of the market, and every scenario is different. You're not going to. It doesn't make sense to use a fixed stop loss, take profit, anything like that. when every scenario on the market is completely different than the last. But I typically look for support resistance levels off the bat. If one is not presentable at a reasonable area, then I move to either moving averages or prior price action. Oh, also, it's important to be aware of important price levels, psychological barriers such as large round numbers, larger moving averages, or just plain support resistance when placing your stop losses, take profits, and such. And what I mean by that, so like, for instance, $10,000 was a huge psychological barrier the first time we crossed it. So areas like that traders are going to be paying attention to just based on the actual number itself. Also, in times of high volatility, I identify my stop loss and take profits order wider to avoid premature stop runs and to maximize profits when the price swings more. Crypto is very volatile, as we all know. And in order to minimize my stop outs, I try to widen that so that way I'm not getting frustrated and having a pretty high stop out rate. Also, the same with low volatility. I might squeeze them in closer or try to identify closer take profits and stop losses. Try not to be too optimistic in the low volatility environments. So moving averages represent the most popular way to set a stop loss. It's a pretty simple tool to use in TradingView. You just go to moving average. There's 3 different moving averages you can use. You do need to familiarize yourself with moving averages if you're going to use them as a stop loss. We're not going to get into how to use moving averages or support and resistance today. All that stuff you should know beforehand entering into a trade. It's all very basic. But yeah, how moving averages do represent the most popular way to set a stop loss. However, here in crypto, I've noticed a lot of people use support or resistance. That's typically what I defer to. There's not a method really to determine if you should use a moving average, support or resistance, or prior price action other than keeping volatility in mind. If we're extremely volatile and the moving averages are not giving me a wide enough stop loss, or resistance or support is too close to my entry, then I'll go look at the moving averages or prior price action that's a little bit wider. Every scenario is different, and it just requires practice to be able to determine which would be the best method at the time. But again, I typically watch for major support and resistance if available in a reasonable area. If it's not, then I'll go look at moving averages and such, as I mentioned a moment ago. Another way to use a moving average stop loss is with the Ichimoku. The Ichimoku is an advanced version of moving averages. It forms an equilibrium in the market. There's several points on the Ichimoku that you can use as a guide. You do need to be familiar with it before you start using it and understand the mechanics of it. I do have a class on that. However, for the most part, a lot of people are familiar with the Ichimoku nowadays. I've marked 2 points on this chart. One is the baseline in pink, where one could place a stop loss in that area. It's also a support area, if you've noticed. And you look over, let me get the pointer. And you look over in this area, we've formed some support. The baseline has been acting as support on the daily Litecoin Bitcoin chart seen here. Also, I've marked Senko Span A there as a potential stop loss. That could be considered a pretty tight stop right there. But the Ichimoku is very useful for finding stop losses. There's a number of ways to use it. It doesn't matter if you're in a bullish trade or a bearish trade. Either one, Ichimoku is very useful. Use longer-term moving averages for more volatile assets, such as cryptocurrencies, to produce the chance that a price swing will trigger a stop loss. However, this does lower your risk reward, so there's a balance and an art to it. So keep that in mind. As I mentioned a few slides back, I typically look for support or resistance when placing my stops. At this point in your trading career, you should be able to identify support or resistance easily. It's not hard to do. I typically look for at least 2 or 3 touch points when placing my stop or when placing my support or resistance levels. If you don't understand how to find support and resistance levels, then I highly recommend you read the countless articles or tutorials that are available online. It doesn't take much more than 10-20 minutes to learn how to identify support and resistance levels. it is key. It's one of the key cornerstones for trading, is being able to identify support and resistance levels. But in this case, this is the same LTC BTC chart on the daily that I was showing a moment ago with the Ichimoku. And we can see here that there is a very clear support level that actually matched up perfectly with the baseline that we were looking at a moment ago on the Ichimoku, where one could place their stop. Another stop placement that I use on an occasion is prior price action. One of the essential pieces of trading is understanding price action or naked charts. I won't get into the mechanics of understanding price action today, as this is a risk management class. However, I do have a couple of price action classes that are pretty effective and clear on understanding naked charts. They are available. But yeah, let me cover this chart. So as can be seen here, we have a prior low on this, I believe this is XRP BTC. You could place a stop loss there. From here, this trade went up really well. I didn't mark an entry or an exit on this, but I just wanted to show a proper stop placement on that. Take profit points. So the same rules to apply to identifying a take profit point as they do to stop losses. Moving averages, major support and resistance, price action history, Fibonacci levels or Elliott waves, but that's also related to fibs. I didn't cover Fibonacci levels or Elliott waves because those are more advanced techniques. But if you are familiar with them, or in the future, if you'd like to become familiar with them, they do work very well, Fibonacci extensions and whatnot. However, I still look for major support and resistance when looking at my take profit points. If none are available, then I'll start to get into Elliott waves and Fibonacci levels. But again, for those unfamiliar with the latter two, I recommend sticking with the same principles I explained for setting a stop loss: moving averages, support resistance, price action history. So now that we've covered stop losses and take profits, something to keep in mind: the reward of a trade is always uncertain, and it's really a potential. Nothing is set in stone when you enter into a trade. So risk is really the only thing that you can control about your trade. So the stop loss is by far one of the more important aspects of a trade. Also, on one note, many traders don't use stop losses. Again, I've railed on this a million times. Once you set your entry, the next thing that should be coming up is your stop loss or your take profits when you're submitting the order. There should be very little time in between then. You should have it all planned out before you even take the entry on whatever asset you are entering into. Let's move to risk reward. So now that you've identified your entry, your stop loss, and your take profits at a reasonable price level for your order, you now need to measure the risk reward ratio. It's pretty easy to do. It's not that complicated. But again, if it doesn't match your requirements, skip the trade. Don't try to widen your take profit order or tighten your stop loss to achieve a higher risk reward ratio. That is a very dangerous way to approach a trade. Many traders do the opposite way. They'll come up with like a random risk reward ratio and then manipulate their stop and profit orders to achieve that ratio. It's a deadly sin in trading. One that must be avoided, and you'll eat up your portfolio that way. That's not at all risk management. The trade is either there and a proper trade, or it is not at the end. But pick them slow and pick them patiently. There's so many opportunities in crypto. There's no need to force a trade. In order to calculate the risk reward ratio, you only need three components: entry price, stop loss, and take profit. So to find your risk reward ratio, you simply divide your net profit, the reward, so the distance in between your entry and your take profit, by the price of your risk, which is in between your entry and your stop loss. We'll get into that a little bit more right now. So let's say hypothetically asset A is $100 at entry. The stop loss we have identified is at $75. So there's $25 risk right there. The take profit point we have identified is at $200. So there's a potential $100 upside. So this equals potential $100 upside and $25 risk. We divide our profit by our risk, and that's our ratio. So we take $100, divide it by 25, and that equals 4. Therefore, our risk reward is 4-to-1. Ideally, 2-to-1 should be your minimum goal for a trade when starting out. There are traders that take smaller risk-reward ratios, but it's typically because they've created a strategy around win rate and risk-reward. We won't get into win rate today in order to, for the sake of keeping this simple and easy to understand. Perhaps in a more advanced class, I will cover this. But it is important to understand that you really don't need an insanely high win rate to remain profitable if you structure your trades correctly. For example, a system with a win rate of 40%, which is what most professional traders average, only requires a risk-reward ratio of greater than 1.6 to trade profitably. But when you're starting out, try to identify 2.0 or higher for your risk-reward. But this little graph here shows that you really don't need to have that many successful trades in order to remain profitable. Win rate is typically useless, but when you're comparing it to risk-reward, strategies can be developed around it. Example down here, with a risk-reward ratio of 2.5, the required win rate is 28%. That's not very high, but that just goes to show you really, cracking the code on being a profitable trader in cryptocurrencies is not that hard to do. Okay, so let's move to position sizing. We're moving along pretty quick here, but there's a number of ways to size trades. To keep this simple and also to offer my approach, I typically like to stick to the 1% rule when entering into a trade that aren't long-term investments. So 1% of my portfolio per trade. There is scenarios, obviously, where I go less or more, but for the sake of this presentation, we're going to stick with this 1%. Additionally, I typically stick to the same rule when leverage trading. Leverage trading provides amazing opportunities. There are zero risks. There are zero reasons to be maxing out your account on every trade. Leverage trading is intended to minimize risk to our portfolio, not maximize it. There's many traders that are just learning, just starting out, that have almost all of their cryptocurrencies, all their Bitcoin or their dollars on an exchange, and every trade they see or signal they see, they're maximizing out their entire portfolio, and this is the wrong way to do it. I typically move 10% of my Bitcoin portfolio to a leverage exchange, and then from there I make every trade 10% of that, which ultimately leads me to the 1% rule per trade, 1% of my entire portfolio. So 10% of my portfolio may be sitting on the exchange for leverage, but this allows me to have fluctuations in my account like stop outs or trades that didn't transpire and continue to leverage trade. Because no matter how good you are, you will get stopped out. You will have trades that go bad. There's not a single trader in the world that's 100% accurate. It's the nature of trading and markets. But following the 1% rule means you can withstand a long string of losses, and assuming you have larger winning trades than losers, which you will if you structure your trade right with your stop loss, your take profit, and your risk reward, you will find your capital doesn't drop very quickly, but can rise rather quickly. For major swings that can be identified, though, I have no problem increasing the 1% risk, but that swing needs to be a very convincing move. And what I mean by that is like the bottom of a bear market, for instance. I would definitely increase my position if I'm certain that the bottom is in. And as of now, on January 31st, 2019, I'm not convinced the bottom is in. However, I'm not convinced that we'll drop any further. For now, I'm waiting for the market to break. So let's move to tips. Don't use daily performance targets. Many traders will randomly set daily or weekly performance targets. This is a very dangerous approach to have and you need to stop thinking in terms of daily or weekly returns. Setting yourself daily goals creates a lot of pressure, and it usually creates a need to trade, and you'll force trades, take trades that you typically wouldn't take. But here's some ideas on how to set trading goals the right way. Short term, focus on the best possible trade execution and how well you follow your rules and your plan. Midterm, follow a professional routine, plan your trades in advance, obey your rules, journal your trades, review your trades, and make sure that you learn the correct lessons. Long term, review your trades. And this can even be moved up into midterm too. Review your trades periodically in your trade journal. But focus on how well you executed your trades to get an understanding of your level of professionalism. find weakness in your trading and adjust accordingly. This will always lead to a profitable trading strategy. Control your emotions. Emotions like fear, greed, or excitement can stop you from sticking to your plan, creating potentially negative results. As a general rule, it is considered good practice to let your profits run and cut your losses early. But keeping your emotions in check and sticking to your trading plan can help with this. Which leads me to my biggest secret to date revealed. Many of you guys know it's not really a secret. But before I get to that, this originally was done live. And to be honest, I kind of bombed the live portion, so I wanted to record it not live and upload it for all of you guys. But there was a couple questions that I want to cover. One person had asked, what about slippage when calculating risk reward? I don't calculate slippage into that. However, one way to avoid that is to not use market orders. You can place limit orders. Now, I know limit orders don't always trigger, and if you are counting on your stop loss to trigger, one thing that I have done is, if the exchange allows it, is I add a golden parachute market order below my limit order. So I'll place my limit order, and then for my stop loss or my take profit, and then I'll place a market order below that if the market allows it. Not all markets or exchanges allow that, and so you can't always do that. But at least if the limit order doesn't trigger, there's not a taker on that other side, then you can at least have your market order trigger with a less favorable price, but it at least avoids some of the slippage up until that point. But I don't calculate that into my risk reward. There was one other question, I believe. It was about cutting losses early. I try to stick to my plan. If there is a black swan event, that's affecting an asset that the price hasn't already been dialed in, then yeah, I may cut it before it gets stopped out. But it has to be pretty damn convincing for me to do that. My biggest secret to date revealed: discipline, discipline, and discipline. I cannot stress enough how important it is. Get your plan together and stick to it. Never deviate from it. Like I said, you can be a bad analyst, but as long as you stay disciplined and structure your trades right, you can be profitable. And there's many traders that are great analysts, but they don't structure their trades right, or they don't stay disciplined, and they're not profitable. That is the biggest key to risk management. You need to learn to manage your emotions. It's the biggest key to trading, really, not even risk management, just everything in general, and having longevity in this market, not getting wrecked. A lot of people say, oh, you need to blow up your first account. You need to lose everything you have with your first account before you can be a profitable trader. That's not true. Yeah, you do learn a lot of lessons when you lose all your money. But generally, if you're a new trader and you go into this correctly, you don't need to lose money to make money in the future. Just do it right. Just learn, educate yourself, and stay disciplined. One thing I do a lot that doesn't always work for everybody is I meditate a lot. When I've gone on long trading sessions, I'll meditate beforehand or in the middle of it, or even when a trade goes south. That helps me. Sometimes I work out. A lot of individuals that works for, they have a gym next to their office, or maybe some weights, and they'll blow off some steam when a trade goes bad, then come back and remain laser focused. So you need to find your balance, and you need to find what's going to keep you disciplined. But yeah, meditation, working out works well for me. Sometimes I'll go and talk to a friend after a trade goes bad. Talking about it works too. Venting, listen to some music, whatever you need to do in your life to stay disciplined. Just do it. Whatever needs to be done. If you need to structure your day so that way when it does come time to trade, you are profitable, do it. Money is not to be messed with. And I highly recommend, you practice on demo accounts and also real money accounts, and then compare those two, the results on that, to see if your emotions are in check on both and you're getting the same results. With that, I think that should be it. Trade safe and stay disciplined, guys. Thanks.